For those that just joined, please note that this meeting will be recorded, and I will post this on the Bay Tennington YouTube channel. So if we miss anything, don't worry about it. We'll make sure we have a library for you where you can access it. Okay, we are going to get started. So welcome everyone. My name is Dolann Adams. I am an associate with the Bay Tennington team. I am excited to have all of you here today to discuss Real Estate Financial Fitness 101. Today with me, I am so honored to have Richmond Kodua and Joshua Willis of Vault Mortgage. I also have with me the amazing Donia Horton, who is a financial educator in the Los Angeles area. So please, once again, get your notebooks, get your pens or your phones or iPads or whatever works for you, and make sure you take your notes to notate any questions or maybe anything that you might want to discuss with me afterwards. All righty, here we go. So this is what we're going to do for the evening. So I'm going to talk a little bit about myself, the vision, why education is important, programs, preparation, working with the lender, and then what it means to leave a legacy. Who am I? So I put this little blurb here, but I am a person who began my real estate career as a first-time home buyer. I like to affectionately call my first purchase the Orange Palace because it was god-awful. I made a purchase sight unseen. And so I did a lot of work to it. And I was very fortunate to have received guidance from some of the best in the best, who I also happen to work with now, the Bay Tennington team. And they actually really made me feel like I was in $1 million purchase, which kind of inspired me to make sure that I could be the same person to other people and educate them as best as humanly possible. So my goal is to be transparent, authentic, and remain well-informed and give you the best service humanly possible, which includes effective communication. So my first-time homebuyer experience was a little challenging, not from my realtor's perspective, but from the lender perspective. And so I refuse to let anyone that I ever come in contact with ever have that experience. So that being said, that is the reason and my purpose for becoming a realtor, and I hope to be of service to you in the future. Okay, our vision. So the Bay Tennington team, we're all Los Angeles natives. So we know the city very, very well. We all have specific areas that we focus on, but the goal is to make sure that we advocate for you in every transaction, that we make sure you are well informed, that we help you interpret the real estate process as much as we can within our space. So for example, we are not lenders, so I would defer you to Richmond or Joshua for lender questions, but we might be able to help you understand maybe some of the language that is being articulated to you when it comes to real estate documents. When it comes to financial planning, I'm probably going to refer you to Donia Horton because she has an expertise in that area. But we are here to be of service to you, to advocate for you, and to also just make sure that we are not only helping you get into your first home, but your subsequent homes, and of course, to create lifelong friendships because we're really cool people and we love you. Okay, so education. So I think it's really important to be well informed. I was a little bit of a nerd when I purchased my first home. And so I actually took a couple real estate classes. I don't expect everyone else to do that, but it's interesting that I did that because we found out recently there's many households, right, that do not um, have the access or the preparation to purchase a home. And so I think that is super, super, super important to understand and to know. There are if we think about our public education system, about 20% of teachers feel confident enough to speak about financial planning. And that's kind of low, especially in a state where the real estate is quite expensive. It's definitely someone's largest investment. So that's always something to consider. So that means a lot. So when we're talking about elevating our clients and making sure that they are well informed, and we're talking about first-time home buyers specifically, we want to make sure that you are well educated, which is really the purpose of this virtual workshop this evening. So let's talk about the state of the market. Many people have asked, what is the state of the market? What does that mean? And so it means a couple of things. So, how many people have heard low inventory? Just nod your head if you've heard that. Maybe yes, okay. So low inventory means that there are not a lot of homes in relation to the number of buyers. So right now, specifically in the Los Angeles market, I would say there is more inventory, not low inventory, more inventory probably in the 1.4, $1.5 million range. But if you're like normal, like a middle class person who's maybe their pre-approval lands in between maybe like 700 and a million, the inventory might be a little lighter, meaning a little more challenging. But if you're in a condo, there's a lot of inventory there right now as well. And I'll let Joshua and Richmond speak to that from their perspective because they receive all the loans for them. And so they can give you more firsthand experience from a lender's perspective. And so when you think about what you want to do, you need to think about the inventory. So when we had all this overbidding happening, it was because there was low inventory. We had low interest rates. And so it was cheap to borrow money. So people were like, okay, I will overbid to get the house of my dreams. So then I never have to go anywhere. Well, now things have changed. Those interest rates are probably not coming back. Again, I will defer to Richmond and Joshua to discuss that. And so we have to reimagine our home purchase, whether it's for the first time, or maybe it's a secondary property for, tax reasons, or you need a tax shelter, or maybe it's, maybe you want a vacation property. So we have to reimagine how we approach that. So steps to sell a home. So if you're in the market, you want to sell your home because maybe you want to upgrade, take a step up, maybe because your family has expanded. I think these are some key elements that you should absolutely consider when purchasing or when attempting to sell your home, which is meet with the realtor to gain a better understanding of the market and comps that will determine the sale price in your neighborhood. Please note the market from 6 months ago is very different from the market to today. And the same with the market a year ago. It's a very different market. So you have to understand that because sometimes in some neighborhoods, there hasn't been a sufficient amount of comps within the last 3 to 6 months to kind of give you a firm landing mark. But that being said, oftentimes as realtors, we might advise you to maybe start at one point, but then leave some wiggle room and say, okay, hey, if we don't see any movement or any traction, let's reconsider our strategy, which might mean a price reduction or a seller credit to make the home more attractive. It just, again, depends on the neighborhood and what's going on at the time. Pay for a general inspection before your house goes on the market to determine what structural and cosmetic fixes can be done. Sometimes some of these minor fixes can really help with value and can attract a lot more buyers. So that's important to know and to understand because the buyers also want to know what they're walking into. And then also, depending upon the home, consider staging to attract buyers to open houses. Sometimes we might love our furniture, but it might not be appealing to the general public. So if you stage your home, you're always guaranteed going to get more offers and probably better offers because sometimes people don't have imagination. They can't see themselves in the space. So that is always an essential tool. Steps to buy a home. Meet with a lender and obtain a pre-approval. So that is why we have Richmond and Joshua here with us today. It is imperative that you meet with a lender to get your pre-approval because you need to know what you are stepping into, what you are eligible for, so that you are actually looking at homes within your price range, right? And if let's say you want to buy a home that's out of your price range, at least you can create a strategy to get there, but you won't know what strategy to create if you haven't gone through that process. Meet with a realtor like myself, and we can discuss homes in your price range, in your area, what you're looking for. Is there a compromise we can land on as far as, if it's dependent upon price point, so that we can get your foot in the door so that you can start building this generational wealth. And then research first-time home buyer options if applicable. I'll get into that in a moment. There are many first-time home buyer options. I would encourage you to look at them extensively. So let's talk about additional costs of home ownership that are not necessarily discussed, I think, in the news, if I'm honest, or not. They're not discussed, I think, frequently, which is mortgage insurance. So mortgage insurance, private mortgage insurance, that means you are coming into a home with less than 20% down. So the bank charges or asks for an extra insurance, which can be up to, I'll let Richmond and Joshua comment on that, but I believe, like, let's say without the private mortgage insurance, your mortgage is X, and then with the private mortgage insurance, your mortgage might be $300 more. So you save quite a bit of money on your monthly note if you come in with 20% down, right? Closing costs, these are one-time costs that happen at the end of the transaction, and that usually means some of these costs are actually tax deductible, so I wouldn't be too concerned, but that is something that you need to be prepared for outside of your down payment. The supplemental tax bill. So let's say you purchased a home from someone who has been in the home since 1975. Their tax bill it will be significantly less than what yours will be. And so you will get a supplemental tax bill after the close of sale. And then any initial repairs that need to make the home livable. So again, as I mentioned, I lived in Orange Palace. And in my Orange Palace, I had to renovate everything, including a bathroom, to make it livable for myself. But I knew that going in, and so I was prepared for that. And then, of course, understanding the true cost and maintenance of upkeep. So if you have a home, the gardener, maybe if you have central heat and AC, servicing the HVAC twice a year, just so that it doesn't cause unnecessary problems, things of that nature. Additional aspects of the purchasing process is the time it takes to close. Um, you won't, a lot of people who have never been in a transaction before, they won't know that, like, to close on a house, you find the house, yay. But now you got to go through the process of getting the inspections, going through underwriting with your lender. And it normally takes 30 days, sometimes 45 days to close, depending upon the situation. So that's something to keep in mind. Um, the home inspection is absolutely essential. And this allows you time to investigate the property to make sure that there's nothing extremely wrong that wasn't disclosed, and also kind of gives you an idea of what you might need to repair. And you get a very detailed report. We work with some great inspectors that are pretty punctual. They are very thorough. They will spend 3 hours sometimes at a property, and you will get a report either that evening or the next morning. Choosing homeowners insurance, especially now in California, especially with single family, we've had a lot of fires. And so it's been challenging, I think, in that area. And so some insurance companies are trying not to insure homes. So you want to make sure you jump on that right away as soon as you get into escrow. And then tax deductions available to homeowners, which includes like the mortgage interest deductions, property taxes, bonded assessments, etc. First time home buyer programs. So I am so excited to talk about the Dream for All that has just returned. So this was a program that was launched in the fall, and the funds for this particular program went in 10 days. 10 days. I'm going to let Richmond and Joshua discuss this further, but this is a program, it's a shared appreciation program that will provide first-time home buyers a 20% down on their home. And there are some income limitations, but it's for low and moderate income individuals. So there are people who maybe make a decent living, and they would be eligible for something like this. So that's really something to consider. There's a City of Los Angeles middle income program assistance, which is also a shared appreciation program that's specific to the City of Los Angeles. And then, of course, we have the Cal HAFA programs, which are other down payment assistance programs available on that site. And I will share that with all attendees at the culmination of this call. Now I'm going to turn it over to Joshua and Richmond to discuss pre-approval, interest rates, rate lock, etc. Joshua, Richmond, take it away.
Yes. Well, good evening.
Good evening.
Sorry that we're in the car. We just finished pre-qualifying the individual right now. Uh-oh.
Oh.
The slide went.
Oh, coming back. Sorry. Here we go.
All right. Thank you. So first thing, thank you for the introduction. I really do appreciate it and being on this platform right now. Just know that the application process is not as intimidating as it sounds. It's actually just a real conversation. From your name, date of birth, employer, what your monthly income is, Social Security, and how much you necessarily are comfortable with in putting down on the down payment. Whether we're going FHA, putting down 3.5%, whether we're looking at a conventional loan, first time home buyer, you're able to put down 3%, 5%, 10%, just whatever you're comfortable with. And it's really just a conversation, a very fluid conversation, back and forth with one another. That application process is around 15, potentially 15 to 20 minutes. Documents, requirements, W-2s, most recent 3 pay stubs, 2-month bank statements. If you're a self-employed borrower, which is also an avenue in which we specialize in, we typically will ask for 2 years of your tax returns, including all schedules like your Schedule C, which is what your self-employment income is on. If you're incorporated, then we'd look more so like at 1120S or a 1065, which is a partnership tax return. If your FICO score is high enough, now, if you've been in business for 5 years or more, we may only need 1 year of your self-employed personal as well as your self-employment tax returns. Did you want to? Here's my partner, Richmond. We've been knowing each other since 1998. We're in the same fraternity together, graduated from the same university.
Awesome.
I lost my voice a little bit. I was a little bit sick, but felt a bit better, so I apologize. Let's get to the interest rate. Right now, currently interest rate, we locked somebody in a week ago, was like a 5.375 on the FHA loan. The conventional loan right now, our interest rate just estimate is between like a 5.8 to 5.9, correct? The average interest rate is like 6 point something. It depends on your credit score. Oh, that's next one.
So as far as locking a loan, with us, we're actually a direct lender. Our parent company is American Pacific Mortgage, and then our DBA is Vault Mortgage Group. We don't charge to lock the interest rate. And locking the interest rate, once again, is a conversation between myself, Richmond, as well as you. And we can lock the loan on 30 days, 60 days, or a 90-day term. And locking the interest rate, what that does, it protects you from the market. As we've been seeing currently, interest rates are creeping up, they're going up, they're ebbing and flowing. But for the past few days, they've actually been inching up. So if we were to lock you at, say, a 5.875 on a 30-day, and you saw that the market was at 6.25, your loan would not be structured at a 6.25. You'd be structured at a 5.875, which would potentially save you an additional $200 from where the current market is.
Awesome. Can you actually explain how often the interest rates fluctuate on a daily basis?
Yeah, so interest rates right now, it's crazy, and it's so crazy that now CNN and local news are discussing mortgage rates in this real estate market. You'll see interest rates sometimes change between 2 or 3 times a day. Similar to, like, say, the cost of gas. You go to the gas pump at 6 in the morning and maybe 4:17. You go there at 12 in the afternoon. It's at 4:25. You go there at 6. It's now at 391. It just goes up and down. And it's our job to be specialists in this market. And we also do a lot of forecasting where we know where the market is actually going, so we can give you the best opinion that we have on the best time and when it is to lock the loan.
Awesome. Thank you.
As far as when you're going through escrow. Escrow is a company in which you want me to go in detail as far as like earnest money deposit,
Please.
thing like that? Okay. So if you were to purchase a house, let's say for $500,000, the typical they want you to put down is 3% into escrow or 2%. It depends upon what Dolann will be able to negotiate for you. If it's 2%, they would want you to wire $10,000 into escrow, and that $10,000 earnest money deposit is good faith that you are going to close on this transaction. If it's 3%, then it's 15,000. And then towards the end of the process, you don't lose that earnest money deposit. That earnest money deposit then goes towards your required down payment. It also goes towards the closing costs, and it's funds that are now being used to close on that deal.
How does it work if you're using a first-time home buyer program like the Dream for All?
One more time.
So how does it work if you're using a first-time home buyer program like the Dream for All program, where the state is coming in with your 20%?
Got you. So you still have to come in and say like a veteran loan, they would ask for like the minimum, let's say 2,500.
Oh, okay.
And then if the Dream for All program, how it's structured, whether it's 20% or 15% down payment, 5% towards the closing costs, then whatever the overage is money that you would actually be getting back.
Awesome. Great.
So you may get your full earnest money deposit back by utilizing these new home programs in order to become a first-time home buyer, and the benefit of seeing your equity grow.
Awesome. And then how quickly can you close the loan? Like, can you share your ability to close with and without a program?
Yes. So typically how purchases are structured are on a 30-day close or on a 45-day close. It really depends also on the motivation of the seller, because sometimes they may need to be also looking for a house. To be super aggressive, we've seen loans that have closed on 21 days. We actually have a program that's labeled a TBD, pre-approval process, that allows you to go through the full underwriting process without actually being in escrow, without having an address. So then all we'd be doing is providing a fully underwritten approval for you to Dolann, and all she needs to do was find a house. And it would actually only have one contingency, which is the appraisal contingency, and how attractive you'd be as a buyer, because you'd now be able to compare yourselves to cash buyers, where you wouldn't have a loan contingency and you'd only have one, which was the appraisal contingency. And at that point, you could possibly close between 15 to 20 days.
Awesome. And can you explain what an appraisal contingency is?
Yeah, so you have 10 days. Typically, it's 10 or 14 days is standard, or 7, depending upon how aggressive everybody is, to get the appraisal ordered, to get the appraisal back, and for everybody to look at to make sure that the appraised value is also matching the purchase price or coming in higher as a benefit for you, because you'd be walking into equity as well.
Awesome. Thank you very much. I appreciate it.
Can I give you
Now,
I think Richmond got just a few
yes,
words.
go ahead.
I'm gonna tell you how I look at the market. I've been doing this for 18 years. I was vice president for Countrywide back in the days. Now I'm the vice president for our company right now. Where the market is right now, whoever buys today is gonna be getting about $100,000 to $200,000 equity in 6 months. And the reason why I'm saying that is I live in Cerritos personally. I bought my house, interest rate back then. I bought my house for, like you said, $220,000 in Cerritos. Interest rate back then was 10%. Everybody used to think that was crazy. Like, why are you buying it? Why are you buying it? When 9/11 happened, rates dropped. And my house right now is worth 1.5. A lot of people are nervous. Should we wait? What should we do? If you wait, interest rate right now, the Fed, based on the Fed said, they're going to lower the interest rate in March, in June, September, and most likely December. So once interest rate do go down, guess what? The house that you wanted for 700,000 now is worth 900,000, because Americans, we leave monthly payment. If they can afford it, they're going to buy it. So I'm telling everybody I know, buy now, refinance later. So the house that you're going to pay $4,000 a month, in 6 months from now, your payment going to drop to 3,000 because you can do FHA streamline to get a lower interest rate, or you can refinance to get a lower interest rate. So I just wanted to give you my sense. You know, we have a house like me, as you know, girl. When I bought my house, another house I bought in View Park was 400,000. In less than 3 years, the same house is worth 1.5. You know, so I'm just telling everybody I know, especially our generation, to buy now because rates is definitely going to go down. It's not going to stay like this. And the Fed said it that they're going to go lower. So don't always worry about the payment. Just worry about in 6 months from now what the payment is going to be, and you can refinance and start building generational wealth, start building equity. That's why, as you know, I end up having 23 houses now because I took that kind of chances.
Thank you, Richmond.
You're
Thank
welcome.
you for sharing your story. Josh, you have any additional comments?
No, I think, just so purchasing a house on the surface can be intimidating, but teaming yourself up with individuals that know your heart, know your mind, share what your goals are, makes the process a lot easier.
I couldn't agree more. Thank you so much.
You got it.
I appreciate it. So I think we now have an understanding of the market. We have understanding of what happens from a lender's perspective. Now let's transition to Donia, where she is going to share with us steps to maintain this large purchase and grow it. So I'm going to stop share so she can share. So there we go. Go for it.
All right. Good evening, everyone. Let me go ahead and share screen. Thank you, Dolann, so much for having me this evening, allowing me to be here. I'm excited to share this. So once again, my name is Donia Horton. I love that you introduced me as the financial educator because education is my background. I've been teaching both at the elementary and collegiate level for over 20 years. And I also am saddened by the statistic that you gave that 20% of educators are qualified to teach financial education. I think that's extremely sad that we are not able to teach this in schools. And that was my passion in getting into finance because I realized that my fellow colleagues as educators, we're educating the future, yet we don't know where our retirement is. We don't know how we're investing. We're not equipped financially to purchase a home and are living paycheck to paycheck. And so, well, I'm saddened by that statistic that you shared. I am also empowered to know that that is why I'm in the position I'm in. So extremely excited to be here. My contact information is below, so you can follow me, Legacy by Donia or legacybydonia.com. Check it out. But my passion is really about making sure that we are leaving this legacy of generational wealth. And while it is so powerful to make sure we are purchasing homes, I have seen so many clients that end up losing a home when a loved one passes away because they don't fully understand how to maintain that legacy and pass it on from one generation to the next. So that's going to be my piece that we'll talk about this evening. So this idea of just really estate planning. For me as a financial educator, my area of expertise is really in retirement planning, but also in different types of insurance. And so when I talk to clients about making sure their estate is protected, many of them are like, "Oh, I'm not making millions. I don't have an estate," right? So it's this understanding what is actually an estate. Really, it's anything with your name on it. And so you don't have to wait to be a millionaire to make sure that your assets are protected. We've worked very hard to make sure our bank accounts, that we have cars, homes, businesses, all of that, anything in your name is your estate. And so how do you make sure that those things are taken care of and then passed on appropriately? So this is why I always say the estate planning conversation is for anyone, regardless of the amount of money that you are making and what you have in place. So we're going to talk about some different components of the estate planning process. And what this has to do with especially maintaining your home and leaving a legacy. One of the things from my background in insurance is understanding the use of term. And term tends to get a bad rap, and it when not used correctly. But I will say, especially when you are purchasing a home. So I'll use myself as an example. When I purchased my home, I was already in my 40s, realized, oh, you know what? If something were to happen to me, my family would not be able to maintain this mortgage payment. right? How do I make sure that my children are able to keep this home that I am privileged enough to have been able to purchase? Well, that's when I was able to get term coverage. Term insurance is exactly like when we say renting a home. I don't own it, right? I'm renting it for that time period. I can cover a cost. My term insurance can cover anywhere from 10 to 30 years worth of a period of time. Term insurance tends to be cheaper, which is why people tend to go for that. Okay, now the benefit of doing this is, think about it. I got a 30-year mortgage. I am hoping I continue on this path, my home is paid off in 30 years, but God forbid something were to happen to me within that 30-year period. I also have a 30-year term. So what happens? That's going to pay out to my family and cover the expenses of this home. Because the reality is, when a loved one passes away, their income goes away. So insurance is meant to be that replacement of income as well. I've dealt with losing my mother-in-law just within the past couple months. We're figuring out how to make sure to maintain that household that now her husband has, to figure out where is that money coming from. So this type of term coverage can make sure that you are now leaving your loved ones without having to worry about the burden of figuring out where this extra money is coming from. Okay, so the coverage is on the owner of the home in the event they pass away, and then leave that to the beneficiaries. We're also going to talk about how you can leave that in your will and your trust next. Okay, so term coverage, I always recommend my clients have some sort of permanent coverage that's going to cover them for their whole life, whether that's a whole life policy, an IUL, a VUL. There's so many different vehicles, depending on what your needs are, that will cover you for your entire life. But term is also a great way to make sure your house specifically is covered. Okay, the next thing you want to make sure as far as your estate is concerned is that you do have a will in place. Okay, wills allow you to state how you want, what your wishes for your property are. They cut down a lot of the disagreements that come up after the fact, after someone passes away. But one of the things I caution my clients against is only having a will in place. Many times, especially, death brings out the worst in people sometimes, and especially when money and property is involved. Wills, they can be contested in a court of law, and they can end up in probate, and families end up spending thousands and thousands of dollars because proper documentation was not in place, and because someone decided to contest that will. So while it is great to have a will in place, the ultimate thing that I also recommend my clients do is make sure that they have some sort of trust. Okay, that trust is a legally binding document that allows you to state exactly how you want your assets dealt with upon your passing. With that document, that allows you to avoid having to go to probate court. And through this, there's a lot of resources online, but I always recommend that people go through a consultation process with an estate attorney. So that way you can have documents that will stand up in a court of law. Should someone have to, you have that contentious, battle over property, that you have the proper documents and the proper legal things in place to cover your property. And ultimately making sure that all of these things, whether it's the term coverage, the will, your trust, that all of those things are covering the assets that you've worked so hard for, and now to pass on the legacy to your loved ones in the long run. Okay, so I offer free consultation. If you have any questions regarding how to make sure your home is covered, how to make sure that you have the proper things to leave that legacy for your family, please feel free to contact me. You can DM me, visit my website, or scan the QR code that goes directly to my calendar, and book some time with me to talk about this any further. And you can also get my information from Dolann. But Dolann, thank you again. It was a pleasure being here this evening, and I'm gonna turn it back over to you.
Great. Thank you so much. I appreciate it. Thank you, Donia. So I am going to share screen one more time. And I'm going to go to this lovely page where you have everyone's information. I know we had a couple of late attendees arrive, so I just want to recap what we covered, which was the state of the market. We also discussed the Dream for All program. And so I encourage everyone, if you are a first-time home buyer, I would encourage you to look at the Dream for All program. Again, as I mentioned earlier, in the fall, this program, these resources for this program were absorbed within 10 days. So I think to prepare for this program, it would be best to start your educational requirement now, and also meet with your lender now, which would be Richmond or Joshua. They are a qualified lender for this particular program. So there's only certain lenders that can administer the funds for this particular first-time homebuyer program, and they happen to be one of them. And actually, Richmond, Joshua, can you talk about any, like, I guess, nuances with the Dream for All program? Does anything have to be done differently if people are going to use that program to purchase their home?
The one thing that you'd want to do is start now, because this program goes live in April. It also is a lottery per se, because the funds are limited, as Dolann mentioned, that the funds I think it was $500 million or $600 million in California was already allotted in less than 10 days. So as soon as this program goes live, April 1, it's gonna be a free for all. So you definitely want to get with lender us now. There's actually only 12 lenders that are actually approved to originate this program in Los Angeles.
Oh.
And we are one of 12.
Oh, wow. I didn't
But
know
we had them.
But we are really the only one.
that. Thank you. Would you recommend that outside of the educational piece that they also get their pre-approval now? Because
Yes, I would. Yes, I would, to be perfectly honest.
right, okay. And so I would so to elaborate on this, so when you have the pre-approval, you're going to get the dollar amount that you can afford based on your income. So that means for the Dream for All program specifically, you're going to get the dollar amount that you're pre-approved for. Then we're going to start, looking a little more heavily for a home, because once that program opens in April, we have to have your pre-approval and the home that you want in place.
That's it.
Because then we have to go into escrow right away so that you can capitalize on that program. Joshua and Richmond, do you want to explain what that looks like? Like, did you have clients the last time that were in the queue for that program and then couldn't follow through with it because the money ran out?
Yes, we had about 16 to 22 clients
More than that.
that were in the queue, and when we got the fateful news that the program had stopped, because they didn't even allow you to register a loan as soon as those funds that are allotment, and it was an estimate, because the loans were coming through so fast within California that they just had to prematurely turn it off. And we had people that were signing contracts. Once the weekend came and we had these contracts to present, that Monday it was already gone.
I mean, on top of that, I had a client that was about to be in the program. The funny part is, I told the client, let's run your credit. No, Richmond, I have a 700 credit score. When we ran the credit, the FICO score have dropped to, like, what is it, 610? Because there was a student loan late on it that she didn't even know about. So I always tell people that I'm trying to be proactive and prepare, because even though we might have the perfect credit score, the perfect everything, but sometimes things happen in life that you don't have control over. So it's always good to prepare.
Would you recommend that what did you call it? TBD?
TBD, to be determined. Yes, TBD.
Would you recommend that level of pre-approval for the Dream for All program?
100%. Yes, ma'am.
Okay.
Just to stay ready. I mean, if you stay ready, that you don't have nothing to lose. You always got to prepare, but don't wait to the last minute. You know, every time you wait to the last minute, something always got to happen. Whether the headache or stressing out. But if you prepare now, you be always ready when the program comes. It just make your life easier.
Okay, and then how long does the pre-approval last?
Usually for us. It lasts for 4 months. 4 months.
Okay. And so generally, can you explain to our audience what happens, even though they might have a pre-approval, let's say this month, but if they don't find a home until next month, can you explain how many times their credit will be run before they close?
Well, usually the credit does, like the same thing. The credit doesn't expire when we run it, because we are direct lender. It lasts for 4 months.
Okay.
For our credit score. So after 4 months, the credit expires. So once you run the credit, we are okay. We don't have to keep on running it. The only
Okay.
time, but at the end, when you're about to close, there's a thing called soft pull. They do the soft pull, just make sure that you don't have it. You haven't
Your debts haven't increased, or
Yeah.
you haven't bought that dream car that you were trying to sneak into your garage. or
Or
whatnot.
go to Target and try some stuff at Target or something, you know?
So I think in general, the rule of thumb is when you're about to approach home ownership, don't open any major lines of credit.
Right.
Don't run up any additional debt. Just make sure you keep your finances stable until the close of the transaction.
Correct. And don't co-sign for anybody.
Oh, yes, because their debt counts as your debt. Can you explain?
And lastly, if you have a car, not a lease, but a purchase. So let's say you own a car and you have 10 months of payment left, it can increase your buying power. So let's just say you have a car note of $800 a month, and you only qualify for like, let's just say 600,000. Then you have 10 months left. We can omit the car. Now you go from qualifying for 600,000 to like 750 because they go by monthly payment. That's how we go by it. That's how we come up with a debt to income ratio. Your monthly outgoing. The monthly payment is very important.
Okay. Can you also speak to for those who might own properties, if they take out a HELOC on their property and how that payment will calculate into their debt to income as far as what they qualify for and how you determine that?
I mean, when you take a HELOC, let's just say you take a HELOC for $100,000. Mostly your payment might end up being what, $600 a month, $700 a month. They'll also take that into consideration that, okay, you have a debt now, like a credit card, you have a debt now. They have to factor that into your debt to the debt to income ratio, including your mortgage, including your car note, including your credit card, including your student loan, including your HELOC. They take all that, and while we take all that and then add it up versus how much you make a year, your gross amount. So let's just say your total outgoing is about $6,000 a month, and you make about, let's say, $150,000 a year. So we take the $6,000 your outgoing divided by your gross amount, not the net, the gross amount. That's how we come up with the debt to income ratio.
Okay. And so for those who don't know, a HELOC is a home equity line of credit. So this is a line of credit that often people will pull from for like major renovations to their home, or some people will use it to pay off debt because the interest rate is maybe less than the credit card interest rate, but it does fluctuate. So this rate fluctuates with the market. So your payment could be $400 one month, and then the next month it could be $600, for example.
Correct. Correct.
And so that fluctuation will also impact what you are eligible for when it comes to home purchase.
Correct.
Awesome. And then how have you seen like someone purchase a car, for example, and then it kill their loan because they did it while they were in escrow? Have you seen that happen?
Oh, it happens.
It happens a lot.
Every day.
We can
We're
preface
like
this conversation
Yeah.
not to do this, and they're like, it was a deal of a lifetime.
So this client we had, he thought he was trying to be sneaky. And at the end, excuse me, they have a soft pool. So they want to make sure that you don't, because they run your credit. But keep in mind, they do a soft pool. Every bank do a soft pool. So when they did a soft pool, they called Joshua and I like, Joshua, did you know that your client bought a car for like $600 a month, and the debt to income ratio was right there, like almost. And we called the client. He said, "Well, what's wrong with that? How did you find out?" I said, "We know everything, So sometimes I always tell the client, you have 30 or 45 days just to wait and buy. You can buy a helicopter after the loan closes. I don't care what you do. But while you're here, you buy a house, just wait. Some people are not patient. You just have to wait till the loan closes because anything can happen any given second. And the underwriters, that's what they do. We fight with them all the time. This is what they do. And that's why Joshua and I, we number one lender in America now, because we are very creative and we think outside the box. Very outside the box.
Awesome. So reminder, don't buy the car, don't buy that large furniture purchase.
Or don't get a timeshare. Don't get a timeshare either.
Oh, can you discuss that? What's the disadvantage to owning a timeshare?
Well, unfortunately, the disadvantage is that you're never able to utilize a timeshare. And that payment, whether it's 350, 475, also comes with the maintenance fees.
Yes.
It also comes with annual dues. So yeah, you got that free buffet, or you got that free dolphin swim ride, and you got to kiss the dolphins and take pretty pictures. But then you have a $700 payment that is going against your monthly income on a property that you're not able to utilize its full service because of your job, restrictions or whatnot. And it's very difficult also to try to sell the timeshare. That follows you
everywhere you go. I mean, it's sad, like, let's just say out of 100%, let's just say 85%, the people we know wanted to sell back their timeshare. They were disappointed. They're not happy. But if you decide not to pay it, it's gonna affect your credit. So sometimes one of my clients, it's privacy, one of my sorority sister, she decided not to pay. I said, no, you have to pay. But when she was buying a house, it affected her. She couldn't buy it because her credit score dropped to like 550, all because of the timeshare.
Mm.
So you also have to be careful about the timeshare. Like I said, you can buy the helicopter, the airplane, but just do it after you buy the house. You can quit your job too, but don't quit your job while we're in escrow. I mean,
Okay.
we see it all. We see somebody quit their job right before we close. So they also have to verify your job at the end to make sure that you're still working. Now, once the loan get funded and get recorded, I'm not trying to give you bad advice, but you can quit your job after that and get a new job. But you cannot quit your job doing escrow. That can also affect you.
Okay. And then I have another question. I'm going to open it up to the floor. Can you talk about the minimum credit score required to purchase?
You need for FHA and for VA loan, you need a minimum of 580 credit score, and that's for VA and an FHA.
Can you
And
can you explain what the FHA and VA loans are?
for a VA loan as a veteran, if you're buying a house, you can buy up to 2 or 3 million. You don't have to put anything down. You can put zero down if you're VA. To be honest, I learned all this when after college. I wish I would be a veteran if I knew all this kind of stuff. I didn't know about what that FHA. You have to put a minimum down of 3.5%. So let's just say you're buying a house for 500,000. Then you multiply 500,000 times 3.5, which is about what, 17,500?
17,500.
17,500. That would be the down payment, right? And if you have an amazing agent like Ms. Adams on the phone, there's a thing called closing costs, which she can negotiate the closing costs. Usually the closing cost is between 2% to 2.5% of the purchase price. So if the purchase price is 500,000, the closing cost you're looking at about maybe 14 or 13,000, including the down payment. So the down payment will be like, let's say 17,500 plus the closing cost. So you're probably looking at total about 31,000 for FHA loan. But Miss Adams I've seen her happen. She have negotiated. We even had a loan that she negotiated to get our client closing cost cover.
An additional credit right at the end.
Right at the end to help out. So you also gotta have an amazing agent that basically gonna work for you on your behalf. But you need at least minimum 580 FICO score for FHA. And a conventional loan, you need about 620 credit score.
Awesome. Great. Thank you. And
You're
now
welcome.
I am going to stop sharing. I'm going to take questions from the floor. So quick question. Student loans have been forgiven recently from one of the clients, but it's still showing on the credit. Will it come up as forgiven in the pre-approval process? Does this particular person need to supply any sort of documentation that says that the loans have been forgiven?
Yeah, so if the loans have been forgiven, they'll probably have a letter in the portal, and we can actually utilize that letter to omit the school loan payments. The school loan companies have become a lot more friendlier to lenders, and they are actually providing these pieces of documentation right off the bat.
Oh, awesome.
And usually our clients are, they're busy working. That's why we have somebody like Joshua. I'll call, with a client, and Joshua usually make it happen. He get it done. He get it later. We need that later.
Okay. Very good. And then in general, would you say school loans impact?
100%. So during COVID, everybody was automatically in forbearance. The lenders, Fannie Mae, Freddie Mac, FHA, they didn't care because at some point you will have to make that payment. So initially they would come up with the slogan of you'd have to utilize 1% of the outstanding loan balance. So if you had an $82,000 school loan, then your payment was $820 artificially, even though you weren't making a payment. But they had to use that for debt to income ratio purposes when you do start making a payment. Then recently, FHA came in and said that they're going to use 0.5% or 0.5, right? So then that reduces it down to 450. Now with your lenders, now there's a thing called an IBR, an income-based repayment program. That payment program is based on your gross income. So if you make $60,000, but you have school loans for $200,000, they may have calculated only $25 for your school payment.
And we can use the $25.
And we can use that $25 for a school payment.
That will give you more room for more buying power.
Awesome. Thank you very much. Are there any other questions from the floor before we go ahead? You can unmute yourself.
Okay. I had a question about the loan. Is there like any advantage for doing the conventional loan? Because it sounds like the FHA loan is like, a lower credit score, lower percentage down. Like, are there any certain advantages to doing a conventional loan?
Well, this is the part of me and Jasper disagree. We agree and disagree. Personally, FHA have the best interest rate. Like I said, FHA interest rate is 5.375. The PMI, back in the days, it was good to go conventional because the mortgage insurance was way cheaper, right? It was less to go conventional. But now since the FHA lowered their mortgage insurance, personally, I will go with the FHA. The only thing is FHA, have the upfront mortgage insurance. Let's just say a house for $700,000. The government will charge you 1.75%. So they will add additional 11 or 12,000 on top of your loan. But they do have a lower interest rate, and the PMI is not that much different. A year, 2 or 3 years ago, I'll tell everybody to go conventional because the mortgage insurance, let's just say $800,000 house, if you put down 5%, the mortgage insurance would be like $200. But conventional loan have a higher interest rate.
Okay.
You know what I'm saying? So they're trying to play that stupid game and it pisses me off sometimes. But they do have right now, FHA interest rate is like what, 6.375. But or 6.25, but conventional is like a 5.375. So but guess what though? If you go into single family house is good, but not all. Some loans, some houses don't have a FHA approved. Let's just say it's a condo or a townhome. You got to make sure it's a FHA approved condo. Let's just say it's a VA. You better make sure that the condo is a VA approved. I have a client right now, is an escrow. They're buying Briarwood in Inglewood. The FHA just expired, so we can't even go FHA. So we have to go conventional.
Got
But
it.
if it's a single family house, it doesn't matter. You can do VA, FHA. That part is up to you, or conventional. That part is up to you. But if you have a 670, 660 credit score, I would tell you to go FHA all day versus conventional because the interest will be higher. And the interest rate for FHA, what is a 585 credit score, 630, it's not that much different at all. I see, like I said, I see what the Jewish people doing it and the Asian people doing it in Santa Monica, because I'm telling everybody I know, my peoples, to do the same thing. That's our job, to make sure we give you guys education. These banks don't care for us. If we die today, they're still going to be here. So whatever we can say or do to make sure you save your money, that's our job.
Thank you.
Is there a purchase limit for FHA depending upon
Yeah.
county?
Yeah, they just increase it. Right now, Orange County and LA County, if it's a single family house, I think it's 1149. If it's a single family house. If it's a duplex, I think it went to like almost 1.3 something. Then triplex, fourplex, it start increasing. Now if you buy in Riverside County or San Bernardino County is less. I think Riverside County and San Bernardino is about, for single family houses, I think 700 and I believe it's 725,000 is
Mm,
less for
okay,
Riverside and San Bernardino County.
right.
So let's just say you buying a house in Riverside for 900,000. Don't think about you can go FHA. You can put down 3.5% because the county limit is lower.
Right.
But let's just say you buying a house for in LA County for 1.1, you can put down 3.5%, which is about what, 30 something $1,000 down. But you cannot do that for Riverside County or San Bernardino County. Because the
Okay.
county limit is less.
And so that's nationwide for those who might be considering purchasing homes outside of the state of California. You can look at the FHA limits in your state or county. You can look those up and you'll find those. And I have one more question. I know there might be some people who might be interested in buying a secondary home, like they already own a primary residence, but they might be looking for an investment property. Does the pre-approval process differ for them? Is the interest rate higher for them?
For a second home, no, second home pretty much price is the same as a primary. Whereas on an investment, you will see a difference potentially about maybe a half to 3/4% higher.
Okay. But do they have to come in with a certain dollar amount, or can they come in with 5% or 10% down?
Well, let me tell you how average American being creative in this industry. Okay. I have a client, well, we have a client. Well, this client that we just seeing right now, we all know that they're buying a house right now, but they're trying to downsize. So they have a single family right here. It's worth 1.5 right here. And they're buying a duplex in Newport, right? If they were 40, 45 years or less, we all can know that it become investment property. But at a certain age, we know how to be creative and tell the underwriter, look, they are trying to downsize. So it's still considered owner occupied, which they are going to live there. So they didn't have to put anything down. But they also create a lease that somebody going to rent out their place that can be under the income we can use to qualify them if you have a lease.
Awesome.
But some people always ask us, how do people buy 2 or 3 houses? Because they have a lease. Bottom line, I'm just keeping it raw. Because they have a lease. Nothing else. Nothing magic. You don't have to make 500,000. Because I started working at Blockbuster, making 425 an hour, and now I own 23 houses. Well, 22, 23 houses now, and I just built a hotel in Ghana because I refinances it and bought. So it's not nothing magical. You just got to take that chance. That's it. That's what. Just take that chance. That's it.
Awesome. Thank you. Are there any other questions? I know it's 8:03. Any other questions? Okay. Well, thank you all for attending. If you have any further questions, please let me know. I will send a lovely little email with some of the resources so that you all can have them readily available at your fingertips. And of course, feel free to DM me, call me, text me, whatever floats your boat, and I will be happy to answer or meet with you to address any of your concerns and get you connected. But I would encourage you, if you have not done so, and I'll share a screen one more time, feel free to notate these lovely professionals' contact information, because they offer a wealth of knowledge and can really guide you, especially for those who are going to be using first-time homebuyer programs, on next steps and kind of getting ahead of it so that you're ready to go once this program goes live. All right. Thank you once again, and good night.